Hello, everyone. Warm welcome to another Timber Exchange webinar. Today, we're discussing CME lumber futures. It's great to see a global audience as usual. So let's tell and show the speakers, today's guests, where in the world you are watching from. So down in the chat, please write where you are watching from. It's always really interesting to see where the audience is. Okay, we have Quebec, Canada, Tamil Nadu, India, Helsinki. I see a lot of names that I recognize. Some of you might be shy today. Alison and Tom, where are you guys joining from?
I'm here in Chicago.
I am actually calling in from Singapore, and I see India on there. I'll actually be in Mumbai and Delhi early next week.
Excellent. We have somebody from Arkansas as well. Warm welcome to everyone. Really good to see you all. I recognize some names from Sweden, the Baltics, Japan, Germany, Austria. Global audience, really cool. Warm welcome to everyone. So without further ado, let's jump straight into it, shall we? Today, this webinar is about it's an introduction and strategies of CME lumber futures. And our guests today, or honorary guests, are none other than Alison Coughlin, Director for Commodity Research and Product Development of the CME Group, and Tom Crane, Director for Agricultural Business Line of the CME Group. And we'll be starting shortly, but first, a small message. The host of today's webinar is, of course, Timber Exchange, and we host 3 monthly webinars going and covering global lumber markets. And in the Timber Exchange platform, you can track more than 400 market signals from around the world for more than 40 global lumber markets. And we're the first company on a consolidating basis. What is global production? What is the global inventory level? How are global trade flows or even global consumption of lumber? But most importantly, and valuable for you, market participants, is that we track global lumber prices in more than 26 key markets. Over the past few months, we have expanded the product list, which we track. We've improved the product definitions to avoid misunderstandings. And we publish 170 prices for 170 products in 26 key markets on the 15th of every single month. And the amazing thing is, every time that you choose to contribute prices to the price survey, even if it's just one price, we as Timber Exchange donate meals for a whole week to a single family in need. And our goal is to distribute more than 1 million meals over the coming 12 months. And here you can see some of our previous and recent work, which we're very proud of and very thankful for your support. Without your support, none of this would be possible. And our goal is to distribute 1 million meals. So every time you contribute, you are making a real change. We actually calculated it. If you contribute prices 12 times in a year, that's more than 1,000 meals on your behalf, which you are yourself directly responsible for. So you can have a very good and positive impact actually by contributing. And now, without further ado, let's jump in and discuss and learn about lumber futures with the CME Group's Alison Coughlin and Tom Crane. Warm welcome. Thank you so much for coming on. We really appreciate it.
Awesome. Thank you very much, Amir. Thanks for having us. Thanks everyone for joining. We are super excited to be here. And just by way of quick background, again, my name's Tom Crane. I've been with the CME Group, based out of our Chicago office for about 8 years now. Prior to CME Group, I spent 4 years in the United States Marine Corps as an infantry machine gun team leader. I did 3 deployments through the Marine Corps. When I got out, I went back to school to get a degree in finance from both DePaul University and Northwestern's Kellogg School of Management. And then I started my career at CME Group, working primarily as our business analyst, assessing market liquidity, working on liquidity provider programs across all of our products, not just lumber, but across corn, soybeans, wheat, livestock. And then currently, I act as the product manager at the exchange for lumber, fertilizer, and livestock futures and options markets, responsible for the overall growth of those markets.
Hi, everybody. I am Allison. I have been with CME Group for about a dozen years now, covering lumber for 10 years. So my team, research and product development, we work within CME Group to launch new products. So when we put new products out into the market, my team is responsible for coming up with contract specifications in conjunction with Tom's team, writing the rule book, liaising with our regulators. We're also responsible for maintaining our existing product portfolio. So through this should be no surprise to all of you, cash markets and physical markets are constantly changing, and we need to make sure that our futures contracts are reflecting those underlying changes. So any amendments that you see to existing products comes from my team. And then lastly, our responsibility is exactly what we're here doing today, which is market education. So writing collateral, giving presentations, a lot of that will come out of the research team. And prior to joining CME Group, I worked for the federal government for 5 years, the US federal government. I did international trade, not derivatives trade, but handled international trade negotiations on ag products for the US Trade Representative and the US International Trade Commission. So a dozen years ago, it was definitely a shift. I was in your shoes when I got a call from CME. I said, I don't know what futures are, and I should probably learn a little bit about futures before interviewing for a job at a derivatives exchange. And so now I have the pleasure of getting to speak with all of you and educating the market on sort of a futures 101. So excited to be here. This is the small print, but I will pause to say, I am not a trader. Please do not take any of this as trade advice or specific trade strategies, that the exchange is recommending that you implement. I always like to start these sort of presentations with a little bit of a story about how CME Group started, because I think it really illustrates sort of why futures exist and why futures are important. So this is a little bit of a US-based history, and I know we have an international audience, so hopefully you all still find this interesting as we do. I always think it's fascinating that the roots of CME were in agriculture. I've worked in agriculture my entire career. I cover greens and oilseeds still to this day. And so I think it's amazing that this giant global company has its roots in the grain markets. So in the early to mid 19th century, we're going way back, Chicago started emerging as this merchandising center for grain. Back then, it was mostly corn and wheat. But because of the geography of Chicago, there was a population center that provided demand. And Chicago is surrounded by a lot of agricultural production. So there was also supply. And what sort of naturally started happening was farmers would harvest their grain and they would bring it up to Chicago. And there were merchants that stood on street corners throughout the city buying this grain. And that sounds simple and it sounds great, but in reality, no one knew what the value of that product was, because the merchant on one corner might be buying corn for $4 a bushel, and down the street, another merchant might be buying it for $5 a bushel. And so some merchants were overpaying, some farmers were not getting as much as they could have been getting for their product. And so in 1848, 12 businessmen from Chicago decided that they could better this system. And what they did was incredibly simple, but changed the way that we trade commodities today. They set up a physical location for buyers and sellers to come together. That was the first trading pit. So merchants and farmers would come to one centralized location to buy and sell their commodities. And every time a transaction occurred between a buyer and a seller, the price and the quantity was written on a chalkboard. And what that did for the market was allow everybody to see what the fair value of that product was. So they knew that they shouldn't undersell or overpay. That then evolved into what we know today as futures contracts. If the same farmers kept coming to the same centralized location and seeing the same buyers year after year, this sort of trust started developing. And that evolved into forward contracts. So I don't necessarily have to bring my corn up right now. We've had a long history of me proving that I can deliver corn when I need to. And so I can contract my corn to you for the next harvest year. And that evolved into futures contracts, which are really just standardized contracts. And we'll get into that a little bit later. But until the 1990s, early 2000s, really, all of this trade happened in that physical pit location. So people, would call runners that would go execute trades on the trading floor and then run it back, call your clearing firm, etc. And it was really fascinating. There's a lot of interesting history on this, but the picture that you see all the way on the right is the pit today. We went electronic. Almost all of our trade volume is now done electronically. And so it has really enabled global participation. You don't have to, you don't have to call the floor or have someone standing on the floor executing trades for you. It is available sort of at your fingertips all across the world. So that's a picture of our global command center, where we see trades sort of go through today. So as I said, forward contracts naturally sort of evolved into futures contracts. I always get questions on futures contracts seem so complicated, or I don't even know where to start. I don't know what futures contracts really are. And so this is the most simplified definition. It is simply a standardized contract. So when buyers and sellers were coming together on the floor, instead of each sort of speaking a different language in terms of, I'll bring you X quantity or Y quality, futures developed. We launched our first futures in 1877 here at the Board of Trade that were standardized across commodities. So the first ones were corn, wheat, and oats. It was 5,000 bushels of, now it's number 2 yellow corn. So instead of saying 5,000 bushels of number 2 yellow corn or a truckload of spruce pine fir, you can say one futures contract. It just sort of harmonizes the language and makes everyone understand what you're referring to when you say futures. So it is merely a standardization of a forward contract traded through an exchange that acts as the buyer to every seller and the seller to every buyer. So we are guaranteeing all of those standardized contracts that flow through our exchange. Tom, you're muted. Okay. Sorry for the technical difficulties. So all of the people on this call, generally, we refer to as cash market participants. So we aren't here to compete with the cash market. We need the cash market to exist so we can lay derivatives. So this chart just shows the differences between cash market attributes and futures market attributes. I think Tom is back, so I'm going to let him go over a couple of these details and I can fill in as necessary.
I am back. Sorry about that. I just got disconnected. But I think as Allison was just mentioning, just real quick, while cash markets and futures markets are related, there are a couple distinct differences between the two. So cash markets, it's where you trade like in lumber specifically, it's where you trade physical lumber. It's where you're buying and selling the actual physical commodity. The price is negotiated today. It's a spot price. It's what you're going to pay for that product today. It's between just you and whatever customer you are working with, between you and a counterparty that you generally know who it is. And you open yourself up to what's called counterparty default risk. So if one side of the transaction doesn't follow through on that transaction, there's some potential financial liability associated with that. In the futures market, it's a little bit different. In the futures market, you're trading a specific contract, a standardized contract, where in the physical market, you have a lot more flexibility in how you design a contract. In the futures market, it's very standardized. You are buying and selling risk versus the physical product. And the goal is a little bit different. The goal is, instead of buying and selling the physical product, the goal is to manage the price risk around that product. In terms of delivery, that is set by the exchange. We have a very detailed rule book that Allison does a very good job of putting together, detailing every aspect of that physical commodity, of that futures contract, including the physical delivery, if it's a physical delivered contract. And then instead of just transacting between you and a customer, if you trade a futures contract, you're interacting with many different customers. In lumber specifically, where it's traded on what we call Globex or the screen, you don't know who you are trading against. You're trading in a pool of liquidity, we call a pool of market participants, willing buyers and sellers taking the opposite side of your transaction. And then also, the futures market is guaranteed by CME Group. So CME Group acts as the buyer to every seller and the seller to every buyer. So there's a very limited chance of default risk associated with trading a futures market.
So next, I want to talk a little bit about why futures exist and sort of the two purposes that they really serve. It boils down to two things: price discovery and price risk management. And what I think is so interesting about price discovery is that this is a benefit that is conferred upon the entire marketplace. You don't have to trade futures in order to take advantage of this purpose or of this reason why futures exist. So if we were in a physical room right now, is when I would ask people, who here looks at the lumber futures price every day? And a certain percentage of hands would go up. And then I would say, who here trades lumber futures? And a significant amount of hands would go down. And so I think that really illustrates anyone can go on our website and see the price of lumber futures at any time. That is sort of a public good. And I often am asked, how does CME come up with these prices? It is my favorite question because I sort of get to dispel this notion that CME is acting as the price setter. CME is merely the platform. We are just that physical, if you will, location where buyers and sellers come together to discover these prices. And Tom is going to show a trading screen a little bit later and talk a little bit more about this. But essentially, we're just providing the opportunity for price discovery. And what I think is especially fascinating about this is we list essentially 1 year out. So as we were saying, delivery is standardized. Delivery is set by the exchange. We list contracts for every other month. So our next contract is November. We have January, March, May, etc. And the market is discovering prices for all of these months. So you can look on the website and you aren't just seeing where the market is pricing lumber today, but you're seeing where the market is pricing lumber for the next 6 to 9 months generally. We don't have a lot of activity in the contracts that are listed for a year out, but you can see where buyers and sellers are pricing July delivery for spruce and southern yellow pine. So that enables you to make decisions about your own business without even interacting with the futures market. It is just allowing buyers and sellers to sort of come together and determine where that price is today and where they expect that price to be in the future. So knowing prices or seeing where the market is valuing prices is beneficial, but it doesn't cover your risk, right? If you are a sawmill, you're worried that the price of lumber is going to plummet and you won't be able to sell your commodity, your lumber for as much as you'd like to. If you are a home builder or a wholesaler who's in the market to buy lumber, you're worried that the price is going to skyrocket and you're going to have to pay more for that physical commodity. What futures enables you to do is control your margin. Because the cash market and the futures market are so highly correlated, generally, I say generally, but the vast majority of the time, depending on the product, if the cash market price goes up, futures market price goes up. Conversely, if cash prices go down, futures market prices go down. And so this enables you to take a position in futures that will offset any negative impacts in the cash market. This chart shows a 5-day rolling average volatility for our spruce pine fir contract. This is what you're exposed to if you are not managing risk in the futures market. So, for example, a mill is worried that the price of futures is going to go down. So they will sell futures so they can buy it back if the price does go down and make a profit in futures, even though they're experiencing a loss on the cash side. Conversely, if a buyer is concerned that prices are going up, they are going to buy a futures contract, because if the price goes up, they are going to sell that futures contract for a higher price, make a gain on that to offset any increases in the price in the cash market. I always feel that I need to make the explicit point that futures are a tool to create more certainty. We do have people in the market who are speculators. That is their job. Their job is to buy risk, whereas hedgers are there to offset risk. So if you have physical inventory and you are hedging, you're taking an opposite position to your cash position. So you are gaining in cash and losing in futures, or gaining in futures and losing in cash. The goal is not to turn a profit on futures and in the cash market. That is not the goal of hedging. It's to protect any risk, any adverse price risk. Here are just a few examples. They all use the same number, but I wanted to illustrate what a natural seller and what a natural buyer might experience if prices go up or if prices go down. This also illustrates it is absolutely possible to lose money in the futures market. As I said, the goal is not to be making money in the futures market and in the cash market as a hedger. The goal is to offset any losses. So if you're a sawmill and prices go up, you are going to experience a gain in the cash market because you can sell that lumber for a higher price, and your position is going to decrease in the futures market. Conversely, if prices go down, you're protected. So that is exactly why you put on the hedge, is because you can now sell your lumber for a lower price in the cash market, but your futures position gained value and you offset that loss. On the same side, a home builder, this is just illustrating someone who is naturally buying lumber. If the price goes up, that is why they took a long position or they bought futures. They have to go into the cash market and buy that lumber for a higher price, but their futures position gain in value. Conversely, if prices go down, they're happy because in the cash market, they can pay less for their physical lumber that they need, and their futures position lost value. So risk management is really just a way of locking in margins. If you see a price that is a benefit to you, buying or selling that price means that you are just creating certainty so you can take risks elsewhere in your business. So I want to go back to this definition and apply it to lumber futures. I've highlighted here standardized asset. And Amir, if you can hit the space bar, sorry, I have a little bit of animation here. But the standardized asset in our two contracts are a truckload of SPF or a truckload of Southern Yellow Pine. So this is, we'll compare these two contracts a little bit later, but essentially it is saying number 2, 2x4 random length spruce pine fir, or number 2, 2x4 random length Southern Yellow Pine. The standardized place for the SPF contract is delivered to Chicago. And the standardized place for the Southern Yellow Pine contract is the east side, which is Florida, Georgia, the Carolinas, and Virginia, is where Random Lengths Fast Markets is assessing those prices. So that is the standardized place for both of these contracts. And the standardized time, as I mentioned, is every other month. So on the 15th of every other month, the contract expires and either goes into physical delivery, which we will get into, or cash settles. So that is the standardized time. So this is just the futures definition applied to the two lumber contracts that we have.
And so we currently have two lumber futures and options markets. One called Lumber Futures, which is an SPF contract, and a Southern Yellow Pine futures contract. We tried to make these products look similar in their contract design. However, there are some differences between these two contracts. The Lumber Futures contract SPF is a number 2 2x4 SPF, but it's a physically delivered contract. You can deliver Doug fir, hem fir, fir larch, or SPF. It's a 27,500 board foot contract, which is around one truck. Again, it is a delivered contract. It is delivered to the Chicago switching district. And this contract we launched in August of 22 to replace a legacy contract that we had since the 60s, which was a little bit outdated. It was 110,000 board feet, different delivery mechanism or different physical delivery location. But we've seen a lot of growth come out of this new contract since the redesign. And then we also have a Southern Yellow Pine contract, which is a little different than the SPF contract. This is a number 2 2x4 random length Southern Yellow Pine contract. It's 22,000 board feet, which is roughly equivalent to one truckload of Southern Yellow Pine. This is a cash settled contract, which is a little bit different than a physically delivered contract. The cash settled contract is cash settled to an index or an assessment from Fast Markets, looking at FOB East Side. And this one is very new. This liquidity is still building in this contract. But we see it as a very nice complement to the SPF contract as a whole. And so this, Alison alluded to a few slides ago, but this is an example of a screenshot showing a live market. So this screenshot is looking at CME Direct. CME Direct is CME Group's trading platform. So this is a way that market participants can access the market. But essentially what this is looking at existing bids and offers at specific prices. And these prices are, again, as Alison mentioned, not determined by CME Group. These are willing buyers and sellers looking to extract fair value from the market by posting what they see as fair value in both bids and offers across both Southern Yellow Pine and SPF. And also to note that you can see that there is trading. There are bids and offers across the futures curve, so not just in what we refer to as the front month. You do see prices being quoted much further out, which is exciting to see and something unique to the futures market.
So let's say, for example, you're looking at that trading screen and you see an offer to sell that you like. You feel that that's representative of your pricing structure or your fair value. So you decide to buy a contract. What now? What does that mean? What can you do with that contract? So there are essentially 4 things that you can do now that you bought a futures contract. 1, you can hold it until you no longer need it, and then you can sell out of it. So every single day, we settle our futures contracts based on a volume weighted average of trades during that day. So you have to post a nominal amount of money that is a percentage of the notional value of the contract that guarantees your trade. And so every day that price goes up a few dollars or down a few dollars, and your account gains or depreciates in value by a couple of dollars while you're holding on to that contract. So you bought a contract, you keep it for a few days, and then you sell it. You are now out of that contract. You can roll that contract forward. So let's say you bought a November futures contract and your job is no longer starting until January. So you need to continue to offset that price risk until your job starts. You can roll that contract to the next month. So that just means you no longer have a November futures contract, you have a January futures contract. The third thing you can do is you can exchange for physical. We call that EFP. You can do that on a physically delivered contract or on a cash settled contract. And that essentially means you come to the exchange and you say, I bought a futures contract, but I found someone who's going to sell me the physical lumber. And so we're going to exchange the futures position for the physical lumber. All you need to do is provide documentation to CME Group that shows this transaction. You are giving that person, that counterparty, your futures positions in exchange for that physical lumber. Usually, that person will have an offsetting position. They will be short or have sold futures. And so you can offset your position, and they can offset their position by buying or selling the physical lumber. That does not have to be the reflective of the exact contract. So you can EFP European spruce, for example. It just needs to be submitted to the exchange. The fourth thing you can do with your contract is hold it until expiry. And that just means that once the contract stops trading on the 15th of the month, either you are getting physical lumber delivered to the Chicago Switching District, or you are cash settling out of your position if it is the Southern Yellow Pine contract, which we'll get into a little bit later. But given this audience, I'm not going to spend too much time on the physical delivery aspect. As Tom said, we've had this contract since 2022, and we actually just saw our very first exchange delivery on the September contract. So it does not happen often at all. I would say overall, especially in the agricultural complex, less than 1% of our contracts ever go through physical delivery. Most people will EFP them or roll their positions to the next month, et cetera, and not go through physical delivery. But essentially, what physical delivery means is at the end of the lifetime of the contract, the seller ships the physical lumber and the buyer takes possession of the physical lumber. Whereas on a cash settled contract, it is merely the exchange of funds from one account into another account. So if you have bought a futures contract and the price goes up, you are credited from the seller's account into your account. It's merely a transaction of cash between buyer and seller through the exchange. The final settlement number, the value for a physical contract, is calculated the same way as the daily settlement for both futures contracts, which is a volume weighted average of the transactions that have occurred on the exchange. Again, not set by CME Group, set by buyers and sellers who are transacting on the market. The final settlement price for a cash settled contract is an outside assessment. So as Tom mentioned, in this case, it is a Fast Markets random length assessment. They publish it every day. And at the end of the averaging window, which we will get into, we average those prices, and that is the final settlement price. Generally, physical delivery is, I don't want to say it's more true, but it's inherently tied to the physical market because at the end of the day, you will be getting the physical commodity. Cash settled contracts are tied to the market because what Fast Markets is doing, similar to the timber exchange, they are collecting transaction data. So real physical or cash transactions that are occurring are what is setting that assessment price in order to settle the futures contract. There are some benefits to cash settlement, even though it is not expressly tied to the physical market. The first one is that it can sustain some periods of more limited liquidity. So in a physical contract, you need buyers and sellers there till the very end because that lumber is being shipped to you. You don't want to be trapped without anyone on the other side of the market as that contract nears expiry, because if you can't get out of it, you are responsible for buying or selling that physical product. However, cash settlement, if you can take it to expiry and all it is funds, and you have a very good idea of where that price is going to be by the 15th of the month because the prices have been coming out for 2 weeks essentially at that point. It also allows for broader participation generally, and that is because unless you are in a position to be making or taking physical delivery, in this case, you have to be a North American mill who can send rail cars of lumber to the Chicago switching district, or you have to be able to take lumber at the Chicago switching district. And so as the contract nears expiry, we see fewer and fewer participants in physical contracts, whereas you see speculators staying in, you see hedge funds and asset managers staying in, and you see more international participation holding their positions on cash settled contracts. So how does sort of cash settlement work in the SYP contract? The next slide shows a perfect example of the last few expiries on Southern Yellow Pine. So as I said, Fast Markets is collecting this data on a daily basis, and every day they are publishing their price for Southern Yellow Pine. Their price is based on, as I said, cash transactions that are reported to them from mills, wholesalers, etc. They actually are giving this price away for free currently. So you can go to our website or their website. They have a free daily newsletter that you can sign up for, and it goes straight to your inbox, and it contains the last 5 days of Fast Markets prices. So from, as I said, we list contracts every other month. So the July contract, September contract, November contract, from the 1st of November through the 15th of November is our expiry window. It's our averaging window. Every assessment that Fast Markets publishes during that averaging window goes into our final settlement. So you can see those are the highlighted yellow numbers there. That is, if you sign up for their newsletter, coming into your inbox so you can track it. We do not publish those prices. That is Fastmarkets intellectual property, but we average them on the business day after the 15th calendar day. And that is the final settlement price. And you can see that in green. So that is just what number is used for final settlement purposes, in the sense that if you bought futures at $340 and the final settlement price is $350, your account is credited $10 per thousand board feet and taken out of the seller's account. So this is where you guys are all very much more experts than I am, or that Tom and I are. We do not have a European spruce contract. We don't have global pricing points for lumber, but we do look at correlations. So this is just using the Fastmarkets prices, but obviously Timber Exchange is publishing prices that for European spruce and for other, products that you can be looking at and understanding your risk profile. Almost zero participants are exposed to the exact price that is on the trading screen. And that is because you have to be a mill who's sending lumber to Chicago, or a wholesaler who's taking lumber in Chicago, or you have to be an East Side mill or an East Side wholesale distributor, or an Eastern home builder for Southern Yellow Pine. And in reality, the people who are trading this contract are much broader than just that subset of people. And so what those traders are looking at is their basis risk. They're looking at their cash prices and how highly correlated they are to the futures prices to understand what positions they should be taking in the futures market. So European spruce has higher correlations to our legacy LBR lumber SPF contract, as opposed to Southern Yellow Pine. But as Southern Yellow Pine continues, given where European spruce is imported, we may see an increase in that correlation between European spruce prices and Southern Yellow Pine prices. Or we may see a high correlation at a time lag, etc. But what I always advise, and this is not a trading strategy, but we offer historical settlement prices. Understand how your exposure correlates to the prices that the market has determined on CME Group, to understand how you can better protect yourself from any adverse price movements. Even if you aren't trading SPF or SYP, there may be very high correlations that you can take advantage of to hedge your risk. My last takeaway, if you get nothing from this presentation other than this, is I often hear futures are risky, or it's like betting on delivery, or betting on what the price is going to be in the future. And my gospel is that if you have exposure to physical lumber and you aren't hedging in the market, you are a speculator. You are at the mercy of wherever the cash price goes. So if you are a sawmill and you aren't taking short positions in the futures market, you are at the mercy of the market declining and you being able to sell your lumber for a lower price. If you're a wholesale distributor or a home builder and you aren't taking long positions in the futures market, you are speculating that the price is going to remain constant or go down, because if it goes up, you are now spending more for your physical product. So the futures market is not a place to express uncertainty. It is a place to create certainty when it comes to pricing.
And I think I want to make sure we have some time for Q&A, but just real quick, I wanted to go through a couple statistics around some of the growth we've seen in our two lumber futures contracts. We've seen considerable growth come from our SPF contract. We're currently around 8,500 open interest. And when I say open interest is essentially just the number of open contracts that are currently out in the market. And Southern Yellow Pine is around 168, a little bit less, but keep in mind we launched the SPF contract in August 2022, and we recently launched the SYP contract in the end of Q1 of this year. So these markets are still developing. We're consistently seeing 1 to 3 tick wide markets. And to kind of put that into perspective, if you think about corn, so corn is the most liquid ag futures contract, and we usually see around 1 tick wide markets. So this contract is on average on par or close to on par with what we're seeing in our most liquid ag futures contract. And that's a really important measure for us to look at and for market participants to look at because it essentially reduces the overall cost to trade for customers because they don't have to cross a wide bid and offer. So if we keep that pretty tight, it reduces the cost to trade. In Southern Yellow Pine, we have a active liquidity provider program. So we have market makers in there who are quoting bids and offers throughout the day. So you will see resting liquidity. You will see liquidity throughout the day that you can interact with in that market, both in SYP and in LBR. We just don't have an active liquidity provider program in LBR, which is the SPF contract. Sorry if all these acronyms are a little confusing. We're currently seeing volume trade around 1,000 contracts per day in the SPF contract, which equates to around $15 million notional or around 27.5 million board feet transacted per day in the SPF contract. So with that, I think that's all we had on the overview of lumber futures and options markets. But happy to answer any questions.
That was super, super interesting indeed. Really well done. It's a very complex topic, and you really broke it down and made it very easy to understand. So now to the audience, in a moment, we'll be opening the floor so you can ask Alison and Tom your questions. So down below, there is a Q&A button. Press that button, write your questions, and I will be moderating those questions. And we'll wait for a minute or so to get some questions. And during that time, we will show you, there's something more from you guys.
Just
That
if
was
we got a question on it. Yeah, we don't have to get into it unless people are interested in how we develop futures contracts.
Okay. We'll wait for a moment to get some questions coming in. And we have some really interesting findings recently that we published. Log prices in Finland are on the way down. That's very good news for both mills and buyers. In Russia, production is falling 6% compared to last year. In North America, inventory volumes are on the way down. Currently, and one of the most important and interesting things that I believe we measure is the global sentiment of the market. Right now, 25% believe in falling prices, 25% believe in increasing prices, and the balance, 50%, believe in stability. And from the last price survey that we published, we saw that 42% of products increased month over month. We see currently that 47% of products are more expensive or are priced higher now than they were in January. And currently, the global inventory level is at 21.5 million cubic meters. So let's get into the Q&A. We have a few questions coming in. Let's see what we have. The first question is, for EFPs, is there a specific tally to respect on the 2x4s? even tally 3 to 3 to 3 to 3 is 30,576,000 board feet. How do you get to 27,500 board feet?
That's a great question. So, of course, I'll give a complicated answer. So, until the SPF contract expires, you can deliver anything through an EFP. It doesn't have to be spruce pine fir. It does not have to be a specific tally. It does not have to be delivered to Chicago. It is only essentially saying, I am using this futures price as a benchmark to price my physical transaction. So before we had an SYP contract, we've had SYP EFP'd on our SPF contract. You can EFP, as I said, European spruce. You can EFP anything at any tally on the SPF, on either contract before it expires on the 15th of the month. If you hold that position after the 15th of the month, only on the SPF contract, you have to EFP the specific species written into the rule book. So there are a couple of different tallies that work to get to 27,500 board feet. And the percentages are all laid out in the rule book. But until that contract expires, while that contract is still trading, it is completely open to whatever you want to EFP. No specific tallies are required.
I have a short question. What usually moves the daily price of lumber futures? Could it be housing, mill activity, weather? What could it be? In general terms, of course.
Yeah, it can be any of those things. Certainly, if we have big housing reports coming out, we see prices move. If sawmills announce curtailments or anything like that. Lately, obviously, any tariff announcements or potential tariff announcements that come out, we've seen some pretty high volatility days on some of those announcements. Generally, less so weather unless, I know last spring there were a lot of fires in the eastern United States that impacted SYP production. So unless it's something sort of more along those lines, like a major weather event, we don't see that as often. But definitely housing demand and interest rates, because that will drive some of the housing starts or some housing demand numbers. Tom, anything I'm missing that you want to add?
No, I think that's a pretty good summation.
We have another question here. So, assuming this is from an offshore person, not from the US, assuming they are, the question is, assuming that they are that they are to receive lumber via the CME for an exchange for delivery or delivering lumber, what guarantee is there that the quality being received by the buyer or delivered by the seller is actually to par? And what if there is a claim on that physical product?
Great question. Yeah, definitely makes sense. So our lumber rule book spells out explicitly the quality. And one of the reasons that we have kept the contract mill delivery is because we know where that lumber is coming from. Some in the market would like us to explore allowing redelivery, so delivery of lumber from a reload or a transload facility. It's certainly a very interesting question, but I think we have less control at that point over the quality of the lumber. Whereas if it's coming from a mill, we know that when it was sawn and we know the origin of it. There is a process for making claims that is written in the rule book. As I said, we've only had one exchange delivery. If you EFP a contract, you're essentially removing the exchange from that process. But when it goes through exchange delivery, we CME, the clearinghouse, is guaranteeing a certain tally, quality, etc. And there's a whole process to, if there's a claim on that lumber. We haven't run into that issue, knock on wood. But also generally most buyers and sellers know each other, that are engaging in the physical process, and thankfully have respect for the contract and respect for their counterparties, that we don't see a lot of quality concerns coming through the delivery process.
Very, very interesting. We have a lot of very smart questions. The next question is, how does CME evaluate participants' credit worthiness?
I will let Tom jump in a little bit more on this, since his team is sort of responsible for the growth of the contracts. But essentially, in order to trade on the exchange, you need to be a member of a clearing firm. We have an entire list of clearing members on our website. And so you need to go to that clearing member and say, I would like to trade through you, and you set up an account with that clearing member. And so it's not, you're backed by a clearing firm, and we as the clearinghouse are also guaranteeing that trade. So, we're validating participants through their clearing relationships.
Yeah, and to add to that, so it's not necessarily CME Group specifically assessing the creditworthiness of each customer, but CME Group operates off of that clearing member model. So the clearing member essentially acts as a barrier between CME Group and the end customer. So you have to pass, they're the ones doing the due diligence on creditworthiness. They're the ones handling any margin payments, default risks. And then essentially we are acting as that final line of defense, where if there was a default on the customer and then a default on the FCM, then CME Group is the one guaranteeing that. And there are strict rules around how that operates, but that's essentially how we sort of guarantee each side of the transaction, because we have multiple layers in our markets.
Super, super interesting, very clear. We have some other very smart and interesting questions. So let's say I'm a European producer and my home currency is euros, but I'm paid in USD when I deliver to the US or trade on the CME. How do I pair foreign exchange hedges with lumber futures without canceling the protection?
So my answer would be that we offer foreign exchange futures contracts, so you can hedge that FX risk in the same place that you're hedging the lumber risk. We don't offer lumber futures in any other currencies. We don't offer any of our agricultural US-based contracts in any other currencies. But certainly we have global traders, trading everything. And what we generally hear from them is they will either go to their bank to hedge that FX risk, or take a position in any one of our currency pair contracts to mitigate that aspect of the risk. That's a great question, especially for this audience.
We have another question. If I'm an offshore mill, when should I enter into a contract? Should I hedge at order, at sailing, or closer to arrival, and why?
So I don't want to be seen as giving any sort of advice on this, but what I would say is look at your pricing structure of how your physical contracts are priced in order to guide when you enter or exit a futures contract. If your price risk is at the mill or at origin, that is a different strategy than if you're pricing it landed US Gulf. Certainly there's freight risk, inherent in there. but the prices that I had access to and looked at are landed US Gulf. And that is where I saw correlations with the LBR contract. So didn't look at FOB offshore mill prices. So that's what I would recommend, is look at your individual pricing structure to determine where your basis risk is highest and where your price risk is highest, to sort of ascertain your risk management strategy.
Alison, you've worked with this or both Alison and Tom, both worked with this for a long time. Are there any common misconceptions or misunderstandings that you see with market participants or those interested that are important to just highlight?
Yeah, I'll give my favorite few misconceptions. And then if there are any that Tom missed, please jump in. I hope we highlighted a couple of these. One, the common misconception is that CME sets prices. I am not allowed to give market outlooks or forecasting. I have no clue where the prices are going, so it would be bad on multiple levels if CME was in the business of setting futures contract prices. Another common misconception is that I have to have exact exposure to what's being traded in order to participate. So I hope we cover that in terms of correlation, but you don't need to be a North American mill to sell CME futures. You don't need to have access to pick up lumber in Chicago to buy CME futures. You don't need to have access to Southern Yellow Pine or, direct exposure to Southern Yellow Pine to trade CME Group futures. It is a risk management tool. It is not meant to be another point of sale or an origination tool. It can be that as you get closer to delivery or expiration, but it is there to help discover price and to help manage price risk. And it's a financial instrument meant to create certainty to a broad range of market participants. Tom, any other myths? We hear a lot. I love that question, but we hear a lot of them, so it's hard to narrow down my top few.
Yeah, I think no, those are good ones. I think another one we tend to hear is around physical delivery. It's a little bit different in the grain and oilseed markets, but in lumber, I think it still holds true, where if you're worried about taking physical delivery of a truckload or a rail car of lumber, generally through working with a broker or through your clearing member, you will start getting some calls from them as you approach the match day or the last trade day, asking you if you really want to do this. So it's not as simple as I forgot I had a position on and now I'm getting delivered lumber in Chicago. You will generally have fair warning before you actually take physical delivery. So that's something we hear a lot, is people are worried about taking physical delivery, but it's not that simple to take physical delivery.
Super, super interesting. And one last question is, as a how can non-US based companies, for example, in Europe, Asia, or the MENA region, that are exposed to global lumber, if they want to hedge or speculate or trade on the CME for lumber futures, how do they get started with this?
Yeah, that's a great question. And I think you're certainly not alone. Like a fairly large contingent of our market is international based. So we do have a large participant base that is US, but we do see a lot more European and even Asian participants in our markets, even in our lumber markets. So I think a great place to start, and something we always point to, is speak to a broker. Lumber has a whole host of brokers that are involved. We have a list of brokers that is on our website with contact details, emails, phone numbers. They would welcome any calls. And that's usually a good place to start because they know the markets well. They can help get people set up with a clearing member and get all that paperwork done and everything. And yeah, they're generally a wealth of information.
Super, super interesting. So it's kind of like multiple levels. You have the company that wants to trade, who works with a broker, who works with a clearinghouse, who works with you guys. Is that the correct description?
Yeah, I think there are a few different ways to access our markets, but that is one avenue for sure. It's the participant who wants to trade, go through a broker, go through a clearing member who interfaces with the exchange.
It's not
Super, super.
required to trade through a broker, but
Mhm.
we see it, especially in lumber. It's I would say the most popular route. And for anyone just getting started, a lot of these brokers are sort of full service in the sense that they will evaluate your risk profile and suggest a risk management strategy. And so, especially for people new to futures, the first thing I would recommend is just watch the market, understand your relationship to the market. And a broker can help you do that before even stepping in and starting to execute any trades.
Yeah, and we have a whole host of educational materials on our website, ones that are lumber specific, ones that are futures, and ones that are options, and a lot of white papers and stuff like that. So yeah, our website is a plethora of information on this stuff too.
Super, super interesting. I think that was all the questions for today. Alison, Tom, thank you so much for joining, and thank you to the audience for listening in. It was a sincere pleasure to discuss this very interesting and very important topic at a very critical time, actually, in the market.
Thank you very much for having us. Please feel free to reach out. You can hit both Tom and I at lumber@cmegroup.com if you have any questions. And we're always here to help educate the market and answer questions. Thank you so much, Amir and the Timber Exchange, for having us.
Yeah, thank you.
Our pleasure. Thank you so much. And for those of you that stayed until the end, we have a few special surprises for you. We have started tracking now local sell prices in multiple markets. So your customers, or your customers' customers, what are they selling for? For example, in Europe, in MENA, or in China, like we can see here. And we have something really interesting coming up. So we are soon able to show you real-time delivery and consumption data of lumber. Where is consumption actually happening? And this is much more than just housing starts. Where is it coming from? How is demand shifting? And most importantly, what products are most or least in demand? And we also have customs insights for multiple markets, such as India and the US, who are the biggest buyers, sellers, so that you can benchmark your performance. And we do 3 episodes per month. We have many episodes planned until the end of the year. We look forward to seeing you all very soon again. Alison, Tom, thank you so much for coming on. We hope to see you soon, hopefully at a physical conference very soon. Thank you also to the audience, of course. Goodbye.